Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. CPI at record highs. Official inflation is at the highest level in over a decade, which has many wondering when the Fed will clamp down with higher interest rates. What this could mean for the crypto market. China cracks down on crypto. Social media and search engine bans are burying crypto content while miners get pushed out of provinces. Why this news is not as concerning as you might think. Latin America bets on Bitcoin. El Salvador officially makes Bitcoin legal tender, and politicians in neighboring countries signal their intentions to do the same. Which countries will be next? The dominance of DeFi. 1% of all Bitcoin in circulation is now being lent and borrowed on Ethereum. And Amazon looks set to hire a DeFi specialist. Could Amazon be on the cusp of adopting crypto? Parachain preparations. Kusama officially announces the start date for its first Parachain slot auction. What the schedule is, what projects to look out for, and when we could see Polkadot follow suit. Ransomware attack reactions. The FBI retrieves Bitcoin from the Colonial Pipeline ransomware attack, raising questions about whether Bitcoin was hacked. A closer look at what really happened. Time for Taproot. Bitcoin's biggest upgrade since 2017 will be coming to the blockchain in November. What you need to know and why this upgrade is so important. And a closer look at altcoin carnage in your weekly crypto market update and forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics if you're looking for them using the timestamps in the video timeline. And now for today's top stories. The latest CPI update by the US Labor Department has revealed that inflation is showing no signs of slowing down. For those unfamiliar, the Consumer Price Index consists of a basket of goods and services that are meant to be representative of the cost of living for the average person. According to the CPI, the annualized inflation rate in May was 5%, up from 4.2% in April. That doesn't sound like much, but it's the biggest monthly inflation gain in over a decade. The last time inflation spiked this much was in the summer of 2008, just a few months before the financial crisis. What's even more concerning is that the CPI is not believed to be the best measure of inflation, given that it's been modified more than 20 times over the last 30 years to make the numbers seem less severe than they are. Case in point, using the CPI metrics from 1990 would give the US an annualized inflation rate of more than 13%. This is bad news for the average consumer because the cost of living goes up, but it's usually good news for the average investor who sees their investments match or outpace the rate of inflation. The caveat here is that there are concerns that the Fed will clamp down with higher interest rates, which would bring these inflationary pressures under control. This could crash the price of cryptocurrencies in the short term. Luckily, the general consensus is that the Fed can't afford to raise interest rates because it would crash the economy as a whole and potentially cause the government to default on its own debt. Even so, inflation is something to keep in mind when analyzing the crypto market, and I'll leave a link to my video about inflation in the description if you're interested. Meanwhile, in China, the government seems to be cracking down on crypto. Dozens of Chinese cryptocurrency influencers have been banned from Weibo, one of China's most popular social media platforms. Experts believe that China is trying to make sure that, quote, no Chinese version of Elon Musk can exist in the Chinese crypto market. Critics argue that the Chinese government is restricting access to educational information about cryptocurrencies that is hard to find in the country. China's largest search engines also appear to be restricting searches related to cryptocurrency exchanges, namely Binance, Huobi, and OkEx. This is because searches for Binance, Huobi, and OkEx give 0 search results in the Baidu search engine. What's interesting is that these exchanges can still be found when using different search strings, such as Binance Academy or Huobi Research Center. While it's unlikely these restrictive measures will have any measurable impact on the crypto market, the same cannot be said about China's clampdown on crypto mining. Multiple provinces in the western part of China have told crypto miners to pack their bags, and this has led to a drop in Bitcoin's hash rate last week. However, it appears that China is merely trying to push miners to operate in eastern regions, where there is more sustainable energy and presumably more oversight by the government. It's also worth pointing out that China has not banned the ownership of cryptocurrencies and is simultaneously exploring turning Bitcoin into a legitimate asset class in the country. I suspect that China is simply concerned about the environmental impact of cryptocurrency mining as well as its potential to disrupt the rollout of its central bank digital currency. If you want my full perspective on why this Chinese mining ban could be great for the long-term health of the Bitcoin network, I have a recent video on it. Hit that link in the top right to open up a new tab and watch it once you're done watching the news. Now, crypto media may be getting the clicks with their doomsday headlines, but the reality is that cryptocurrency adoption continues to rise around the world regardless of what's being said in the news. The most relevant example of this is El Salvador's recent bill to make Bitcoin legal tender, which officially passed last week. President Nayib Bukele said that the law will go into place immediately and is giving 3 months for public and private institutions to put in the necessary infrastructure to support Bitcoin payments. What's more is that El Salvador will not tax any gains made from Bitcoin investments and will even educate its population about how to use cryptocurrency. The best part is that the government will allow citizens and businesses to use non-custodial wallets in their operations. Being in the spotlight has put the El Salvadorian administration under scrutiny, however. Some are concerned about the government's authoritarian tendencies and wonder whether its adoption of Bitcoin is in response to its deteriorating relationship with the United States. Still, there's no question that El Salvador's move to adopt Bitcoin has sparked the beginning of a crypto revolution on the Latin American continent. Politicians from Brazil, Paraguay, and Mexico have all added laser eyes to their profile pictures on Twitter. This is much more than an empty gesture, as these politicians are preparing to pass pro-crypto bills in their own parliaments as well. Whether or not they'll be successful remains to be seen, but many believe that El Salvador has begun a domino effect that will lead to the mass adoption of cryptocurrency in Latin America. It sounds far-fetched until you remember that most Latin American countries are heavily reliant on the US dollar, and some of them even use it as their primary currency, including El Salvador. I reckon it's logical that governments there would want to detach themselves from a currency that they have no control over, especially since the Fed has been printing so much of it over the past year. This might actually be why the IMF seems to be pushing back against El Salvador's announcement. The fact that El Salvador is detaching itself from the fiat monetary system and even plans to mine cryptocurrency using heat from volcanoes means it no longer needs to rely on foreign money. This includes loans made by the IMF, which have long been seen as a way of enslaving developing countries. If developing countries around the world start to become financially independent through cryptocurrency, this threatens the increasingly centralized global monetary system we have today. And good riddance. The notion that nations and individuals could break free from the fiat financial system through cryptocurrencies becomes more feasible by the day as DeFi continues to develop. Even though the crypto market has been in a slump over the last month, the total value locked in popular DeFi protocols like Aave has stayed more or less the same over the same period. A substantial portion of DeFi's TVL is coming from wrapped Bitcoin, or WBTC, which makes it possible to use Bitcoin on Ethereum. More than 1% of Bitcoin's supply is currently being custodied by BitGo, the company which mints the WBTC. While Cointelegraph speculates that the rise of WBTC has to do with the attractive yields in various DeFi protocols, I happen to have an alternative hypothesis. I believe that traders are putting WBTC into DeFi protocols to borrow WBTC as a potential hedge against downside risk. As a simple example, imagine Bitcoin is worth 50k and you think the price could drop. You deposit 1 WBTC to borrow 0.5 WBTC and exchange it for 25k USDC. If the price of Bitcoin drops by 50%, you still only owe 0.5 WBTC, which is now 12.5k. Because you have 25k, you can keep the other 12.5k as profit or use it to buy more Bitcoin when it dips. This money magic has managed to attract many institutions, and it seems Amazon is the most recent addition to this list. In a job posting last week, Amazon said it was looking for a blockchain lead with, quote, experience delivering products or innovations in the blockchain space, and in particular DeFi or traditional finance services. Now, before you get too excited, it's likely that this position is in relation to Amazon's job posting from February this year, which was looking for someone to develop a digital currency to be used in Mexico. Conversely, it's very possible that Amazon is trying to keep up with its competition when it comes to crypto payments. I'm referring to the job posting by Apple that I covered in last week's crypto review, which is eerily similar to the job posting made by PayPal shortly before it introduced crypto payments. If it turns out that Amazon is looking to go solo on its own crypto endeavor, I have a feeling that it won't go down too well given how Facebook's Libra project has turned out. You can learn more about Facebook's Libra, aka DM, project by watching my video about it using that link up there in the top right. Another topic I touched on last week was Kusama's Parachain slot auctions, which will begin tomorrow. As a quick recap, Parachain slot auctions are the process by which Kusama and eventually Polkadot will decide which cryptocurrency projects get to go live on their blockchains. Many of these projects will be conducting Parachain loan offerings, which is where you bond your KSM or DOT to the project for the duration that it holds a Parachain slot, which can be up to 1 year. The kicker is that the KSM and DOT you lock up never gets sold, and you also receive tokens from these projects if their auctions are successful. Put simply, Parachain slot auctions are like ICOs, except you technically never spend a penny. According to Crackdown, the projects participating in Kusama's first Parachain auction will be Karura, Shiden, Crust Shadow, Moon River, and Fala. The auction will begin tomorrow at 1200 GMT and will conclude on June the 22nd at 900 GMT. Any KSM you loaned to the winning project will be locked until May the 13th, 2022. Kusama will hold another 4 Parachain slot auctions back-to-back, and I'll leave a link to the full schedule in the video description. I also have a tutorial on how to participate in Kusama's and Polkadot's Parachain slot auctions if you need it, and you can find it using the link in the top right. Assuming Kusama is stable with 5 Parachains plugged in, the Parachain slot auctions will continue on Kusama and will likely begin on Polkadot as well. What this means is that we could see decentralized applications launching on Polkadot by the end of August. And you can look at KSM's recent price action to get a sense of what is likely to occur for DOT. I can't help but notice that a lot of crypto developments are set to occur over the coming months. Whether it's EIP 1559 or Cardano's smart contracts, everything seems to be set for July and August. It's a curious coincidence, and it seems that curious occurrences are common in crypto these days. One curious occurrence that happened last week was the seizure by the US Department of Justice of the Bitcoin paid out in the Colonial Pipeline ransomware attack. Those of you living in the United States will remember that the hack of the Colonial Pipeline caused gasoline shortages around the country, mostly on the East Coast. What you may not know is that there is more than meets the eye when it comes to these Bitcoin ransomware attacks, especially when it involves the seizure of Bitcoin by the Department of Justice. For starters, DarkSide, the group that's behind the Colonial Pipeline attack, apologized for the gasoline shortages it caused shortly after the fact. In an anonymous statement, they highlighted that, quote, "Our goal is to make money and not creating problems for society." To add to the confusion, DarkSide was technically not behind the attack. What they did was license their hacking software to an unknown third party, which then used it to attack the Colonial Pipeline. This unknown third party then demanded Bitcoin as ransom, and the Bitcoin they received is what the DOJ managed to retrieve. When it comes to the question of how the DOJ got this BTC, there are two theories, and neither of them involves hacking a Bitcoin wallet, which is impossible, in case you didn't know. The first theory was detailed in a recent article by Decrypt, and it posits that the DOJ gained access to the private keys the hackers used because they used a centralized cloud storage service provider as part of their attack. All the DOJ had to do was scrape the information about the hackers' private keys from that centralized cloud, and voila, they've got their Bitcoin. Now, the problem with this theory is that if the hackers were tech-savvy enough to hack the Colonial pipeline, then surely they would have known not to store their private keys on a cloud server. So this brings me to the second theory, but first, some background. Mixers make it possible to sever the connection between sender and recipient on the Bitcoin blockchain, and are frequently used by criminals to preserve privacy when transacting in Bitcoin. As mentioned in a recent CoinDesk video, it's very possible that the DOJ is running its own Bitcoin mixing service to catch and track criminal money. If you know anything about US intelligence, you know that this is very much within the realms of possibility, but there's no way of knowing for sure. Either way, this news of the pipeline hack has been fodder for the mainstream news and politicians. Yet again, we've had the old war cries for bans and regulations. However, this seems quite unlikely, especially given the amount of institutional adoption that has taken place. And on that note, institutional adoption seems to be a driving force behind Bitcoin's upcoming upgrade. Over the weekend, Bitcoin's Taproot upgrade finally received the consensus it needs from nodes on the network to be implemented. This is expected to take place in November. Without getting too technical, Taproot will improve the security, scalability, and privacy of Bitcoin by making all transactions uniform. Now, to help understand what I mean by this, consider your average Ethereum smart contract transaction. You can see all the smart contracts and wallets this transaction is interacting with. Although Bitcoin doesn't have smart contracts in the same way that Ethereum does, it does have similar functionality. For example, you can set up something called a multi-signature wallet that will only send funds when all participants who hold the keys to that wallet collectively approve the transaction. Multi-sig Bitcoin wallets are commonly used by wealthy individuals and institutions to ensure that there is no single person who could be coerced into signing a transaction. The problem is that you can currently see all the entities signing off on a multi-sig Bitcoin transaction, and this means that it's possible for someone to eventually figure out who the signatories are. What Taproot will do is make multi-sig transactions appear identical to a transaction that comes from a regular wallet, thereby adding security and privacy for anyone engaging in more sensitive transactions, be it a multi-sig or moving BTC on and off the Lightning Network. The uniformity of transactions also reduces the amount of data that Bitcoin miners need to process, which should theoretically increase Bitcoin's performance. To be honest though, Taproot's scalability effect will probably be quite negligible compared to Bitcoin's last major upgrade, which increased its TPS from 3 to 7. This upgrade was SegWit, and it took place in 2017, just a few months before the crypto market hit its all-time high. The difference is that SegWit required a hard fork of the Bitcoin blockchain, whereas this time around, it's just going to be a soft fork, and that means no action is required on your part if you hold BTC. It's hard to say what effect Taproot could have on Bitcoin's price, but when you're in a bull market, any positive news about a cryptocurrency tends to be enough to push it up by at least a few percentage points. Speaking of which, let's take a look at the leaderboards. As you can see, Bitcoin continues to print a daily price pattern that's characteristic of a Wyckoff accumulation phase. The technical traders among you will know that Bitcoin is close to creating a death cross pattern with its 50-day and 200-day EMA. A death cross usually happens before a big price crash, and smart money knows that this is what regular retail traders are waiting for. As noted in a recent Cointelegraph article, it's quite possible that this death cross will result in a sudden reversal rather than a catastrophic crash. Using the Wyckoff pattern for context, this death cross could cause a spring which takes us out of the accumulation phase. This could happen as early as this week, so be vigilant. This week's winners are Quant Network, AMP, Theta Fuel, Unas Said Leo, and Algorand. Now, before I break down why all of these alts pumped, I want to bring your attention to Bitcoin dominance, which has increased significantly over the last couple of weeks. What this means is that money is moving from altcoins back into Bitcoin, and I suspect this trend will continue. As such, you might want to be careful about investing too heavily in alts at this time. Not financial advice, of course. This week's crypto champion is Quant Network, and QNT's recent run-up seems to be because Quant Network has made the shortlist for KPMG's Technology Innovation Competition. What's interesting about Quant Network is that it's building a blockchain operating system that will make it possible to use multiple cryptocurrency blockchains behind the scenes. You can learn more about that by watching the video I made about Quant Network last year. You know where to find it. As you can see, the QNT token seems to be continuing its upward trend that began over 2 years ago, but it seems to have hit a snag over the last couple of months. I attribute this to the continued lack of exchange support for QNT, and the fact that it's catering itself to institutions rather than the crypto community. For these reasons, I don't think prices will rise much higher in the short term. This week's silver medalist is the AMP token, and its price action was sparked by a sudden listing on the Coinbase exchange. In a nutshell, AMP makes use of a payment network called Flexor to make it possible to pay using cryptocurrency at various merchants. The twist is that merchants have the option to get paid in the fiat of their choice, and transactions are settled instantly. AMP is used as collateral to ensure these transactions always go through. I'll leave a link to my video about AMP when it was still known as Flexor in the description, but I will note that a few things have changed since I last covered the project. An update is coming soon, don't worry. Turning to the charts, we can see that AMP has been extremely volatile in recent weeks, and this might be because AMP's trading volume is extremely low relative to its market cap. The momentum shift from altcoins into Bitcoin means that volatile alts will be the first to feel the pain, and AMP is definitely at the top of the list in this regard. Long term, however, there is definitely a bullish case to be made for AMP. This week's bronze medalist is Theta's T-Fuel token. Now, I mentioned last week that T-Fuel wasn't done going from a technical analysis perspective, and that hunch seems to have been correct. That said, T-Fuel owes its pump to Theta's recent protocol upgrade, which significantly increased transaction fees paid in T-Fuel and introduced T-Fuel burning. When I say significantly increased, I mean that Theta transactions cost thousands of times more than they did before. In dollar terms, this still only works out to a few cents, but it's enough for the fee burn to scrape away at T-Fuel's total supply. With enough network activity, T-Fuel could even become deflationary. The chart suggests that T-Fuel might still have some fuel left in the tank, and we could continue to see positive price action up until the release of Theta 3.0 at the end of June. This week's first runner-up is Unas Said Leo. Leo is Bitfinex's exchange token, and it has been the worst performing exchange token on the market. I think I'll leave it at that. This week's second runner-up is a fan favorite, and that's Algorand. The Algo token seems to be booming on the news that Arrington XRP will be investing $100 million into projects building on Algorand. Now, this is a bit of a surprise announcement, given that Arrington XRP focuses primarily on, XRP. But it's welcome news given that Algorand has been lacking in the financial firepower department. Unfortunately, it's unlikely that Arrington XRP will be able to help with Algo's tokenomics, which have held back its price ever since it started trading. As amazing as Algorand is as a project, I can't see the token going much higher until those tokenomic issues are sorted out, and you can learn all about those by watching my most recent video about Algorand. Top right, if you please. Well, that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, and why wouldn't you? Head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.